Felix here. Why does the market drop every single time you buy a stock? Ever wondered that? Well, if you understand what institutions are doing, if you understand what the numbers beneath the numbers mean, you might start to understand when is a good time to buy and when isn't. And we're going to cover that in this video. Before we do that, get your hands on America's worst stocks. Really, the worst stocks. Why are these the worst stocks? felixfriends.org/662. It's a completely free benchmark because these companies are very likely to run out of money. And there are 662 of them. You might own some of them. So get your hands on this benchmark. Make sure you don't own in them. Or if you do, really dig deep into their balance sheet. Drop me a line if you have any questions. felixfriends.org/662 is where you find them. Of course, none of the following is financial advice. I know that's what we're all here for. You're listening to a golden retriever, basically. So what have we got in store for you here? Well, investors bought ETFs last month, significant amounts. There we go. That was all ETF buying. And what happened? Well, the market decided to once again tank after a little bit of a rally here. And why is that? Well, the Fed said to us, look, rates will be higher for longer, but more slowly. So what does that mean? Well, it just means, imagine you're being racked in a torture chamber and they're just saying to you, you know what, we're going to make this a little bit more intense, but we're going to take our time. And then once it's really painful, we'll keep you there for longer. Is that good news? No, it's not good news, but that's exactly what Jay Powell said. That's what they're talking about. So what do you buy in this environment? Well, actually in this environment, in pretty much any environment, you want to be buying high ROE, return on equity, or ROIC. Take debt into consideration. You want to buy high earnings per share growth, consistent earnings per share growth, not 1 quarter, and tons of free cash flow. Free cash flow margins are key. So if you use something like our portfolio tracker here, type in whatever tickles your fancy. I don't know, Goog, whatever you can think of, Visa, whatever. Hit the update button. It pulls in the data for you. So you can see here, sort of pulls it out, but it shows you what the core numbers are for all of these stocks. So you want to look at a high ROE number. I generally look sort of above 20 percentage points, ideally. There we go. And take into account how much debt they have. High debt means ROE is a little bit manipulated. You want to look at forward PEs compared to current PEs. Current PEs tell you almost just nothing. And then long-term earnings per share growth. Insider ownership, institutional ownership are also quite good metrics to see whether you are roughly on the right path or not. So get your hands on this. It's at felixfriends.org/Patreon, links down below. It's like 20 cents a day or something for that particular tool. And of course, everything else in the community, including the Wonder Marvelous community. If you join us for the year, you get an extra month off as well. So moving on from that, the Fed model is essentially, we look at, let's just go back one step here. Basically, there are more obstacles in the path here. Earnings are likely to drop, right? Some people are saying they're going to decline 10 to 20%. That's why we're just looking at earnings per share growth being consistent. If you look at where we are in terms of valuation here, we're right here compared to the 10-year treasuries. And we're trading at about 17 times earnings. 17 times profit in terms of valuation. So it takes 17 years for the average S&P company to pay you back your money. And that is, something like 30% higher than a usual real bear market, recession market. Now, this Fed model here basically tells you that, look, we are at 1.3 percentage points higher than basically the 10-year treasury. So the 10-year treasury is risk-free, and the PE ratio sits 1.3% above what the 10-year treasury pays you. That's a tiny, tiny premium, and that's like pretty low, right? That's kind of 2009 sort of panic territory. Now, what happens if the 10-year treasury goes up? Well, if the 10-year goes up, what happens? Well, there is more risk-free premium to be had. And you would then likely be going from the present PE of sort of 17.3, you'd go down to, 16, maybe even 15. And That's important, right? That's a big, big, big difference. So what would need to happen to offset this? Well, to offset this, you need profits to increase about 15% to make up for the higher risk-free yield. Because if you think about it, if you've got money and you can put it into something risk-free or you can put it into something with risk, they both pay you the same thing. Well, you're going to put it into the risk-free thing, right? So having said that, Goldman Sachs says, is earnings growth going to be 15%, which is what we need to keep current variations? No, they say 0%. 0% growth. So they're basically therefore saying we're going to end the year end at 3,600 and next year we're going to get 4% growth. That's Goldman Sachs. Morgan Stanley also thinks we haven't bottomed yet. They said we might get a 9% drop in the SPX. And they said the sell-off could continue. We saw an average of 5% decline in the 11 years where we had a similar setup to now. So not exactly like the positivity that you come to expect from me. So what do the options tell us? And the options tell us a lot. And that's one of the key things I always look at. And if you are in the coaching community, you see me do these charts sometimes. So what have we got? We've got on the low end at 3,600, literally a put wall. What does that mean? It means people are hedging. They're saying this is as low as it's going to go. If it goes to that point, I'll make money on those puts. But also those put sellers, sorry, those put buyers become buyers at that point. They have to unwind the trade and that makes them into buyers. So once you get to 3,600, well, you actually would expect to see a bit of a rally. Now, conversely, when you get to, and we're trading right 3,770 at the moment, we are right here, right? 3,770. So if we rally up a little bit to 3,835, that's the call wall. So that's where everyone's going to make money at 3,835. They then pretty much become sellers. So you get to that level and the market essentially turns around. So you are kind of range bound to some extent. Now markets are usually set up like this, but it's much more extreme at the moment than it normally is. And at what point does the market become calm and happy and wonderful again? Well, at 3,841. And that's kind of weird. Normally that level sits below the call wall. So this is basically saying choppy times ahead, at least until the end of next week with inflation numbers coming in and so on. So that's kind of where the market's sitting. Now, there is one more nice support level here. This gray line here, or light blue line, is the 30-day moving average line. Always a line I watch. I'm looking here at the DMA, but it doesn't really matter much. And that's been a support level here the last 2 days. So we kind of bounced off that. And that's sitting at about 3,720. So we drop about 50 points. If that support doesn't hold, we might well head for 3,600, at which point we should see a nice little rebound. So dropping below 3.6 would take something, in my view, that would be more fundamental. Say in December, the Fed comes out and goes, we're going to 6%, not just 5% with interest rates. So I don't see that happening at the moment, but it's all possible. So what does this mean for you, for me? Well, bearing in mind, I'm not going to tell you what to do, but I would say if you have a long-term horizon, it's a great time to buy stocks. If you have a very short-term horizon, don't ever buy any stocks, instead trade. And I got this message this morning, literally 3 hours ago, which is super, super nice to wake up to, from Chris here. He says, I want to thank you a lot, Felix, my friend. I want to thank you a lot for the provided knowledge. Starting with 2,500 in 5 months, almost 300% up. And he shares some screenshots here from his, what looks like a Think or Swim account. So absolutely staggering. How do you get returns that are, well, that's a pretty sizable return. We actually aim for a lot less, but that's pretty staggering. How do you get returns and how do you learn how I make money, how I teach my students to make money? Well, if you have a 5-figure portfolio or a 6-figure or a 7-figure or 8-figure or 9-figure portfolio, give us a call at felixfranz.org/coaching. Me and a bunch of investment bankers and university lecturers make up our community of coaches. We teach you how it's done. You have direct access to me, felixfranz.org/coaching. We'll have a call with you, explain what the process looks like. If you're not quite there yet at the 5-figure portfolio at a minimum, then we also got you covered to accelerate you to get started faster, build the extra income stream, get to your targets quicker, so you can be 5 figures, 6 figures, 7 figures, and so on. Go to felixfranz.org/options. The coupon code there is freedom. And again, you get access to my full trading script, my full trading protocol. You get to see me trade live every week. You have daily chat support. And really what I've developed here is a protocol that's making me a boatload of money, but that is also making thousands of other students a load of money. And what it is a very low risk strategy to trade options, very, very similar to the way Wall Street bankers would trade options. So none of that covered call nonsense, no leaps, none of the sort of really high risk things that are pretty much created to take money away from retail. Our mission here is to actually teach you how it's done, to actually teach you how those guys make money consistently, and telling you they're not writing covered calls. So go to felixfranz.org/options, check it out, and thank you very much for watching. Let me know where you think the market's heading in the comments below. Where do you think we'll be at the end of the year? 3,600? 4,000? Where do you see it? I'd love to get a bit of a feel for what the community thinks. Thanks for tuning in.